let's just try and understand what will be the expectation from the recruiters when they come and recruit the finance student. The first thing that they are going to look for is a strong domain knowledge. Domain knowledge means the subjects that you have studied in your first year, which are related to finance, like accounting and financial management, and the specialization subjects that you are studying in the third semester and probably in the fourth semester. Second, most of the finance job requires analytical skills. So they may look for the candidates who have strong analytical skills or problem solving skills. Third, good communication skills. It goes without saying. The first criteria for any placement drive, the recruiters will look for somebody who has reasonably good communication skills. Now here I'll just give you a clarification. One is how you communicate, and second is the language proficiency that you have. It may happen that you are able to communicate in your mother tongue, or maybe Hindi or Gujarati very well. But when it comes to placement drives, they will expect you to have a reasonably good language command over the English. So that is one area where most of the students actually lack. And this is the area which is actually a make or a break area for any placement. The next is above average Excel skills. I'll just give you an idea about what kind of finance profile generally comes in a business school. Roughly, if we have to give a percentage, roughly 70% of the jobs that come for a finance student is of sales. So it's like marketing a financial product or relationship manager or channel sales. Close to 30% jobs are coming in the area of analytics or core finance or maybe security advisor, or which requires the ability to apply the concepts that you have learned during your finance. But for both, one essential skills that recruiters are looking for is the Excel skill. And for that purpose, we are going to arrange one domain Excel training also in the coming weeks. But goes without saying, in your domain interview also, they will ask something about Excel. Strong general awareness. So since you are a finance student, they expect you to have a reasonably good command over economics or financial topics or what is happening current world. Maybe if banking recruiters come, they may be asking you about policies and all that. So for that, I recommend you to at least read one financial newspaper so that it keeps you intact in terms of updated knowledge. Additional certification, in case during your studies you have taken additional certification like MFI or NCFM certification, they could help you to put your credential into a slightly better place compared to somebody who is not having it. So some additional certification may definitely help you in case you have taken it. You should be able to handle the pressure, and finally willingness to sell. Now, why I have kept this willingness to sell in the highlighted area is just to give you an idea that even though you are a finance student, the first job that you're likely to get, majority of the time, it will be related to sales. So even though you are a finance student, even though you have studied security analysis, portfolio management, even though you have studied derivatives, even though you have studied financial analytics and all that, everything is fine. But the statistic says that majority of the job that comes in the finance specialization has to do with some amount of sales. So roughly 70% of the jobs that you're likely to observe is having an element of sales. So before you go for any placements, please make sure that you have the willingness to sell, right? Around 30% of the jobs will have non-selling component also. So let me give you an example. There is a company called Excel Dynamics, which just came for a placement. Now that is a core finance job. It does not have any sales component. But mostly when you sit for the placements for finance students, the major recruiter is BFSI sector, banking and financial services industry. And most of the jobs which are of the nature will involve some amount of product understanding. Now there is always a fundamental question which is asked by so many finance students, which is that, sir, if you want to do sales, तो हमने finance क्यों लिया होता, हम marketing ही नहीं लेते? This is the first and fundamental question that people are asking all the times, that if we had to do sales, We would have taken marketing after doing finance if we are involved in the sales. That doesn't make me happy. The answer to this question is most of the businesses or MBAs, they are recruited for business development. So some amount of sales will be part of your life. Secondly, why you are better than marketing students in terms of selling a financial product is that you have a strong knowledge of product, which they may not have. So being a finance student, if your domain knowledge is better, you're likely to get a better opportunity compared to a marketing student. So this is just to give you a brief about how industry works. It may happen that you have studied subjects, you are so obsessed with finance, all said and done. Majority of the recruitment will come in the area of sales. So make sure you have some amount of understanding and willingness to sell, because that is something which will be definitely looked into by the recruiters. So bare minimum requirement, strong fundamentals. So domain knowledge may we are going to have a training, right? Communication skills, mock interviews and all that are also arranged for you. Excel skills and Excel training will also be conducted. General awareness, you'll have to do it by yourself. So you can start reading the newspaper and prepare yourself for the interview. Now, basically, these are some of the domains which we are going to cover in next few sessions. Most of the companies, when they come for the recruitment, and if there is a technical interview of finance, they are going to ask questions into 4 broader domains. First is accounting. So they may ask you questions related to the accounting. Second, they may ask you related to basic finance, which is basically financial management that you have learned in the first year. Third, advanced concepts. These concepts are related to subjects which you are learning in the 3rd semester. So subjects like financial analytics, subjects like, let's say, derivatives and risk management. So these are some of the advanced concepts that they are likely to test. And fourth, the most important is profile specific questions. Now, what is profile specific question is the company which is coming for the recruitment, the kind of profile that they are coming for, they will ask questions related to that particular profile. I'll explain you with the example of 2 profiles. The first profile is banking profile. So let's say an Axis Bank is coming for a recruitment and they are interested in recruiting the business development managers. So they may be asking questions related to banking. So they may ask, what are the different types of accounts? What are the different types of deposits? What is CRR, SLR, bank rate, repo rate, and so on. Whereas there is a profile related to financial analytics. Let's say a company is recruiting for a financial analytics. Then they may ask questions pertaining to the area of financial analytics, that how do you do modeling? What is cost of capital? How do you use solver function? What is NPV analysis? So whenever you are preparing for the domain, you have to make sure that the first 3 domains, accounting, basic finance, and advanced concepts, are called bare minimum knowledge. It is expected that an MBA finance should have a fundamental knowledge of these 3 areas. However, whenever a company is coming, there has to be a profile specific questions also, which you need to prepare. Currently, we are going to focus on the first 3 areas, which is accounting, basic finance, and some advanced concepts. So let's start with what is accounting. So whenever any interview is conducted, especially the interview is of a technical nature or a core finance profile, like analytics or corporate finance, they may definitely ask you the questions related to accounting. Accounting, there are 3 important points you need to consider. One is accounting fundamentals. So they may ask you questions related to accounting fundamentals. Second, they may ask you questions related to 3 major financial statements like balance sheet, income statement or profit and loss account, and cash flow statement. And third, the most important is they may ask you questions related to financial statement analysis. So the first topic that we are going to cover is questions related to accounting. Now, what they are going to ask you is, a most frequently asked question is, what are the 3 golden rules of debit and credit? Right? So the 3 golden rules are debit the receiver, credit the giver, debit what comes in and credit what goes out, debit expenses and losses, credit income and gains. They also may ask you, what do you mean by an asset? What do you mean by a liability? What do you mean by an equity? What do you mean by an expenses? Now, here, what mistakes people make it when they ask you what is an asset. Generally, people answer with the example that okay, land is an asset. But when somebody is asking you the definition of asset, it is basically resources owned by the business. So, any resources owned by the business which will give you future economic benefit. Economic benefit means cash flow or economic value. They are treated as assets. Liabilities are basically obligation, the promises that companies will have to pay. Income is basically the cash inflow that you generate by your core business activity. For example, for Marwadi University, the core business activity is teaching. So the fees that they collect is the income or the revenue. Now there is a slight difference between revenue and income. Revenue is basically a cash inflow that you generate from your core business activity, whereas whereas income may be from the sundry activity. Let me just clarify with an example. For Marwadi University, the core business or the core activity is teaching. So the fees that we receive from the students is called an revenue. If we let out our ground for any festival purpose or to any outside party, that is not our core business. So that could be treated as an income. So difference between revenue and income is both are inflows, but revenue comes from a core activity, whereas income may come from a sundry or ancillary activity, right? So now, once you have an idea, you have to understand there is something called a fundamental accounting equation, which is called assets is equal to capital plus liability. So sometimes they ask you this question that what do you mean by a fundamental accounting equation? So fundamental accounting equation is basically assets are equal to capital plus liabilities or resources are equal to claims. That is the fundamental accounting equation. Next is the first financial statement, which is generally asked in most of the interview, is called the balance sheet. Now, people already know what is a balance sheet, and being a finance student, you have a definite amount of idea. But when it comes to expressing what exactly is balance sheet, people have difficulty. So, balance sheet is often described as a snapshot of company's financial condition or position. I'll tell you the three important aspects. Balance sheet is a statement which shows the financial position of the company. Financial position means how many resources you have and how many claims you have. Resources are defined as assets and claims are defined as capital plus liability. So balance sheet is a financial statement showing the financial position of the company. Now, balance sheet is also called a stock statement. So sometimes people ask this question, what is a stock statement and what is a flow statement? A stock statement is something which you prepare on a given day. For example, 31st March 2020. So balance sheet is generally prepared on a particular day, whereas income statement and cash flow statement are prepared for a particular period, for 3 months, for 6 months, for a year. So all statements which are prepared for a particular period are called flow statements, and all statements which are prepared for a particular day is called a stock statement. Now, balance sheet has two sides, asset side and liability side. Assets are called probable future economic benefits. So any item can be classified as an asset if it fulfills three conditions. Number one, they are cash or can be converted into cash. Second, they are goods which are expected to be sold in the future. And third, they are items expected to be used in future activities that will generate cash flow for the entity. So by definition, any item fulfilling any of these criteria will be termed as an asset. Asset in the short term or in a simplest form is something which will give you future economic benefits. So economic benefits will be basically it should be able to generate cash. Now, obviously, when you talk about asset, different asset classifications are always mentioned. So a most frequently asked question in the interview is what is a fixed asset? An unfortunate answer is people will definitely give the example. But there is a criteria, so you have to fulfill three conditions. Fixed asset are those assets which will fulfill all three conditions. Condition number one, the asset is acquired with the intention of use in the business. Second, asset is not acquired with the intention to resell. And third, the asset is likely to give you benefit for a longer period. Any asset which is fulfilling all these three criterias will be termed as an asset. Now, I'll just give you an example. Whenever people ask what is a fixed asset, the answer is building. But if you are a builder, then building is not a fixed asset for you, because you don't build the building to use in the business. Your intention is to resell, right? So whenever you give an example, just make sure that that example has to be fulfilling all three criterias. The asset is acquired with the intention of use in the business. It is not acquired with the intention to resell, and it is likely to give you benefit for a longer period. Second category of asset is long-term investments. Now here there is a classification. All assets held purely for the purpose of investments will be treated as long-term investment if their duration is beyond 1 year. So all the assets which you keep in the business purely for the purpose of investment, like investment in shares or investment in bonds of other companies or land kept for the purpose of investments, that will be treated as long-term investments. They will have a separate category called investment, and all short-term investments will be part of current assets. So the third category is current assets, assets which can be converted into cash or used within 1 year. So the definition of current asset is all the assets which are used in the business or can be converted into cash within 1 year will be treated as current assets, and all assets beyond 1 year will be treated as non-current assets. So all other assets other than current assets are called non-current assets. Then intangible assets, people say you cannot see, feel or touch, but the correct word for that is no physical substance, but it has a value. And finally, you have something called a fictitious asset, which is not an asset, but it is unrealized losses, which are treated as assets, right? Now, I'll just quickly give the examples. So for fixed asset, generally people say property, plant, equipment, land and building, and motor car and all that. For investment, long-term investment in stocks and bonds of other companies or land held for the purpose of investment. Current assets, you have debtors, you have inventory, you have bills receivable, right? You have cash. Intangible asset, goodwill, patent, copyright, trademark, and fictitious assets basically called preliminary expenses or shares or bond issued at deep discount. So that discount will be treated as a fictitious asset. One of the key things that generally is asked in the interview is depreciation. So they generally ask two questions. One is called depreciation and second is called amortization. Now, depreciation, there are so many definitions, but one of the easiest definition to answer is systematic allocation of cost of asset to its useful life. So what is depreciation? Depreciation, basically you're charging the cost of asset to its useful life. So every year, proportion of asset is expensed and it is shown in the income statement. That is called depreciation. Amortization is for intangible asset. So depreciation is charged to the tangible asset and amortization is charged to the intangible asset. So amortization is basically systematic allocation of cost of intangible asset to its useful life. So suppose you have property, plant and equipment, then you will have something called depreciation. But when you have goodwill, then you have something called an amortization. So depreciation and amortization, what are the methods of depreciation? So you have straight line method, you have WDV method. These are some of the questions which are frequently asked in the interview. Now let's move to the second portion of the balance sheet. It's called liability. So liabilities are basically promises or sacrifices which will generate the benefit for the future. Liabilities are basically promises or obligation against those assets or claim against the entity's asset. They are called liabilities. Liabilities are generally of two types: external liabilities and internal liability. External liabilities are basically current liabilities, and long-term liabilities, the liabilities that an organization has towards the outsider of the business. And your shareholders claim or shareholders fund is called an internal liability, which is a liability of the firm towards the internal shareholder. Mostly we never treat shareholders claim as a liability, but for purely accounting purpose, shareholders fund or owner's equity is also treated as a liability because of the concept of separate entity. Now, when you talk about liability, you have something called long-term liabilities, you have something called short-term liabilities, you have shareholders fund, and there is also a term which is frequently used called contingent liability. Now, let's talk about long-term liability. Any liability or obligation that you have to fulfill beyond 1 year. So you took a bank loan and you have to repay that bank loan for 5 years, which is beyond 1 year, will be treated as long-term liabilities. Short-term liabilities are all those liabilities which you are expected to pay within 1 year. For example, creditors are normally expected to be paid within 1 year. Bills payable are expected to be paid within 1 year. Shareholder funds is equity share, preference share, reserves and surplus, share premium. Contingent liability. This is also most frequently asked question in some of the interviews. What is a contingent liability? The definition is very simple. Contingent liability is a liability which is contingent or conditional to an event occurring. So it is not an actual liability. It will become a liability based on the action of a particular event. Let me just give you a very simple example of the contingent liability, which is called bank guarantee. So let's say you took a loan and you were studying your MBA by taking a loan. So you are a borrower, so you are supposed to repay. But bank will always ask for a guarantor, that who will guarantee your loan. So let's say you involve your father as a guarantor. Now your father does not have this liability. You have this liability. But in case you default, then the liability will transfer to your father since he is a guarantor. So contingent liability is basically a liability which may occur based on a condition. It's not an actual liability. It is never shown in the balance sheet. It is shown as a footnote. Contingent liability may become an actual liability if a particular event is occurring, right? For example, in case of guarantee, if you default, then only liability. Now, some of the examples of contingent liability is warranty claim. Then derivatives are also contingent liability. If you have taken derivative positions, it may be contingent liability. For example, if you have taken a forward position, or maybe if you have taken an option is a better example. Somebody is exercising the option, then only it will become the liability. So if you are a seller of option and the buyer of option exercise that option, it will become a contingent liability. So you need to just kind of understand what is a contingent liability. So when you talk about balance sheet, basically you should be aware about the items of the balance sheet. So asset side what you will be there in the asset side, what will be there in the liability side, what are the treatments, what is depreciation and amortization. These are some of the fundamental questions which are generally asked. They may also ask that how do you really evaluate a balance sheet? So the correct answer for that is by calculating certain ratios, which we are going to cover at the later part of this session. So first fundamental statement is balance sheet. So when you go back and prepare for your interviews, you have to take into consideration these points. In balance sheet, what do they generally ask is, what is a balance sheet? What are the different types of the heads in the balance sheet? For example, assets, which are the heads in the assets? Which are the heads in the liability? They may also ask definition of the certain items. Second important statement is called income statement. Now, balance sheet is a snapshot of the financial position of the company, and income statement is a snapshot of operating efficiency or profitability of the company. So if you want to know how profitable a company is, you should actually look at the income statement. Now, there are so many methods of preparing income statement, but one of the method is multi-step income statement. So this is one of the method of calculating or preparing multi-step income statement. Sales revenue are the revenues that you generate from the core business activity. Cost of goods sold are all the cost of producing and selling probably producing the product. The first level of profit is gross profit, which is revenue minus COGS. Then you have something called an operating expenses, like selling, general and administrative expenses. So all operating expenses like salary, rent, electricity bill and all that will come here. Then you have something called depreciation and amortization. One thing you have to understand and keep in mind about depreciation and amortization is they are not actual expenses. They are just accounting entries. So they are non-cash expenses. So they may reduce the income, but they are not paid in cash. Then you have something called an operating profit, which is called profit before interest and tax. Then you have to adjust for other income and expenses. Now, other incomes are income which is not part of your core business, and other expenses are expenses which are not related to your business. Then you have something called an interest expense, which is financing cost, pre-tax income, income taxes. Then you have to adjust for something called special items or extraordinary expenses. Special items or extraordinary expenses, one of the example could be discontinued operations. So if you have operation in the one of the area, let's say you have a business operation outside India, and because of some reason you are closing down that business, that will be treated as discontinued operation. So whenever you prepare or whenever you are going for an interview, some of the questions that they are going to ask is, how do you calculate gross profit? How do you calculate operating profit? How do you calculate net income? What is coming under SGA? What is COGS? What is depreciation and amortization? So you should be able to answer what will come in where. Why interest is not treated as an operating uh, expense? The reason is very simple. Interest is a financing expense, whereas income statement focuses on operating, so it will not be deducted as a selling, general and administrative expenses. So some fundamental understanding of income statement will be there. What kind of profits are there, what you will include in cost of goods sold, give us the example of operating expenses, SGA expenses, what will come in other income. Now other income could be income from your investments. Suppose you have invested in mutual fund and you are receiving some dividend, that could be other income. Other expenses could be expenses related to employee benefits like provident fund contribution and all that. That could be treated as other expenses. Losses will also come as an other expenses. So loss from the portfolio or loss on anything will also be part of other expenses. But this loss, you have to make sure has to be from the investment. It should not be loss from fire, right? That will come under different category, right? So this is about the income statement. So you have balance sheet, you have income statement. The third thing that you should know is a cash flow statement. So balance sheet talks about the financial position of the company. Income statement talks about the profitability of the company, and cash flow statement talks about the cash position or movement of cash within a given year. So it will explain the changes between two dates, right? And this is how you actually make a cash flow statement. There are two methods. One is called the direct method. There is something called an indirect method. So this is the format of preparing the cash flow. They are not going to ask you the format in the interview, but you should still be knowing. So you start with net income, add back non-cash charges like depreciation and amortization. Why you are adding back those charges? Because depreciation and amortization are non-cash expenses. So it will reduce the income, but it will not reduce the cash. So in order to nullify the impact, you have to add back. Then you have to do the changes in current assets and current liabilities. So you will get something called a cash flow from operation. Then you have to adjust for investing inflow and outflow. You will get cash flow from investing. And then you have to adjust for financing. Then you will get the cash flow from financing activity. If you add all this, you will get a change in cash flow, and then you can reconcile the opening balance. So change in the cash flow plus opening balance will be equal to closing balance. Now, what kind of questions are generally asked related to cash flow statement is, what is cash flow from operation? What is cash flow from investing activities? And what is cash flow from financing activities? So cash flow from operation is cash flow generated by selling the products or providing the services. So any cash flow which is generated by the core business activity will be part of cash flow from operation. So receiving cash from the customer, paying cash to the suppliers, and paying cash to the operating expenses could be cash flow from operation. Cash inflow and cash outflow. Second, cash flow from investing is basically cash flow generated by buying and selling long-term assets and other investments. So any cash flow that you generate by buying or selling long-term assets or investments will be part of this. And financing is any cash flow generated by obtaining and repaying the capital. Now there is a shortcut formula that somebody is asking what will come in investing. So all cash flow related to long-term asset. See, if I have to tell you in the balance sheet, I've classified balance sheet into 4 categories: long-term assets, short-term assets, long-term liability, and short-term liabilities. All long-term assets related cash flow will go in investing. So there are 2 long-term assets: fixed assets and long-term investments. They are generally treated as long-term assets, and some of the intangible assets are also long-term. So any cash flow related to all long-term asset will be classified as an investing cash flow. Any cash flow related to short-term assets will go in operating cash flow. Any cash flow related to long-term liability will go as a financing cash flow. All short-term liabilities will go as operating. So any short-term asset and liability related cash flow will be reflected in CFO, cash flow from operation. Any cash flow related to long-term asset will be reflected in the investing side of the cash flow. And any cash flow related to long-term liability will be reflected in financing side of cash flow. Some of the questions which are asked in the interview are, give us an example of cash flow from operation. So cash flow from operation, may you have examples like receiving cash from customers, paying cash to suppliers, or paying cash for operating expenses. This could be the example of CFO. The second, they might ask, give us the example, what will come in cash flow from investing. So buying and selling of long-term assets, buying and selling of investment, and receiving dividend. Now please make sure there is a confusion area. When you receive dividend, it is from your investment. So that will come under cash flow from investing. But when you pay dividend, it is financing, because generally you pay dividend to your shareholders, so it is a financing flow. So if you receive dividend, it is cash flow from investing, and if you pay dividend, it is cash flow from financing. So that is a third statement. So now you have something called all 3 statements clear. Maybe when you go back from the training, study in detail how do you prepare it, what are the items and all that. But generally, whenever you sit for any finance interview, you may expect some questions from the all 3 statements. Now the most interesting and most frequently asked questions is related to financial statement analysis. So there are 3 ways to do financial statement analysis, and you all know. One is called horizontal analysis, second is called vertical analysis, third is called ratio analysis. Now we don't have time to discuss everything, but I'll just introduce. Horizontal analysis is basically a year-to-year analysis. So what happens is, you take item in a particular year, let's say 2014, then you check the same item's balance in 2015, and then you report what is the change. So that is called a change analysis. For example, sales in 2014 was 5 lakhs. Sales in 2015 is 4,75,000. So there is a decrease of 25,000 over 5 lakhs. So there is a percentage change of 5%. So change analysis is called the horizontal analysis, which is year-to-year analysis. So whenever somebody is asking you what is a horizontal analysis or what is a year-to-year analysis, your answer should be comparing the balance of the items of financial statement from 1 year to second year and reporting the change. That is called a year-to-year or a horizontal analysis. Second is called vertical analysis, which is also called percentage analysis. These kind of questions are very common in analytics or core finance kind of interview, that what is a vertical analysis. So in a vertical analysis, you convert the income statement or balance sheet or cash flow statement from amounts to percentage. Now, why do you compare or convert into percentage? When you have percentages, it is easy to compare because absolute amounts cannot be compared. So whenever you are trying to do the vertical analysis, you convert all items of income statement as a percentage of sales. So you assume that 5 lakh is 100%. Now 2,69,000 is what percentage of 5 lakhs? So that is 53.80.
1,63,000 is what percentage of 5 lakhs? It is 32%. So the entire income statement is converted into percentage by assuming sales as 100% and by converting all other items as a percentage of sale. That is vertical analysis. If you are doing for balance sheet, then you assume total assets and total liabilities as 100% and convert all items as a part of the total assets or total liabilities. So that is about horizontal and vertical analysis. The next is the most frequently asked question in finance is ratio analysis. And obviously you all know what is a ratio. So ratio is basically relationship between two variables. Now you have different categories of the ratios like liquidity ratios or leverage ratio, profitability ratios, valuation ratios. Now you have multiple types of ratio and you can actually create lot many ratios, but some of the frequently asked questions related to ratio analysis. So we'll be covering some of the ratios because ratio analysis itself is a very long topic and you may not be able to cover the entire thing in one go. But some of the ratios are frequently asked in the interview. For example, what are the liquidity ratios? So first you should know what do you mean by liquidity ratio, and second you should know what is the ratio. Third, you should know the formula, and fourth, you should know the interpretation. So whenever you are preparing for the interview and you are looking for ratio, what you need to understand is what are the main categories of the ratio. For example, liquidity ratio, leverage ratio, profitability ratio, valuation ratio, right? Second, what will come under those ratios? For example, for liquidity, you have something called a current ratio, you have a cash ratio, or you have something called a quick or acid test ratio, right? Then for leverage, these questions are most frequently asked ratios in banking interviews. That what do you mean by interest coverage ratio, or what do you mean by debt service coverage ratio? Now these two ratios are actually calculated by bankers to evaluate the credit of the borrower. So interest coverage ratio is earning before interest and tax divided by interest. Debt service coverage ratio is EBITDA divided by total debt burden, which may include principal repayment plus interest. Debt ratio is total long-term liabilities divided by total assets. Debt to equity is total long-term liabilities, shareholders fund. Then you have some profitability ratio like net profit margin. So net profit divided by sales into 100. Gross profit margin, gross profit divided by sales into 100, right? Then you have something called a return or profitability ratio. Now profitability ratio and return ratios are actually considered in one category only. Now there are three important ratios which are generally asked in the interview. What is the formula of ROA, return on assets? And second, what is the formula of ROI, return on investments? And third, what is the formula of ROE, return on equity? Now these are some of the formulas. There are different variations possible, but I have taken some of the variations. So it may happen that you might have a different idea, but still when you go back, check for the formulas. Return on asset tells you that how much return is generated against the total assets. Return on investment is actually how much return is generated to the providers of capital. Like you have funded your company with liability and equity. So how much return is generated against those claims? And return on equity is how much return is generated purely for the equity shareholders. So how much return is generated against the assets? How much return is generated against total capital? So this ratio is return on capital employed also, and average equity. Now some of the formulas or ratios which are asked in the interview is EPS. So EPS is basically earnings per share. So earnings per share is nothing but total earnings divided by number of shares outstanding. Then you have something called dividend per share. So out of that earning, you may pay something as dividend. So dividend per share is total dividend divided by number of shares outstanding. Then they will ask you two important ratios. What is a payout ratio and what is a plowback ratio? So payout ratio is DPS divided by EPS and plowback ratio is 1 minus payout ratio. And finally, the most frequently asked question is price to earnings ratio. What is price to earnings ratio? So price to earnings ratio is earnings per share. So price per share divided by earnings per share. What does this ratio indicates? This ratio indicates, number one, how much market is valuing you against your earnings. Let me just give you a simple example. Let's say your price of the share is $100 and your earnings per share is 10. So 100 divided by 10, 10 times is market valuing your share. So price to earnings ratio has to be 10 times. So price to earnings ratio actually indicates that against every dollar of earning, how many times market is valuing you. This ratio is actually used for the purpose of stock valuation, right? Then you have something called an efficiency ratio or activity ratio. So what is a total asset turnover, inventory turnover, debtors turnover, or payables turnover? These ratios actually tells you the efficiency or activity or asset utilization, how efficiently you are utilizing those assets, right? Okay, now the most important thing is how do you evaluate the ratio? Sometimes they may ask you that my current ratio is improving. Is that a good sign? Or my debt ratio is improving. Is that a good sign? So whenever you try and calculate a ratio, you have to compare it with something. So what you can compare is you can compare a ratio with the prior ratios. You can compare a ratio with competitors ratio. For example, TCS can compare with, let's say, Infosys or Wipro. You can actually compare your ratio with the industry standards, and you can also compare with the predetermined standard. For example, in certain banking companies, the ratios are defined by the regulator that you should have this much of the ratio. Then probably you also have to see the ratio is consistently improving, rising, or falling. Let me give you an example. Current ratio indicates that for every $1 of current liability, how many dollars of current assets you have. If this ratio is improving on a year-to-year basis, it's a good sign. If this ratio is falling on a year-to-year basis, it's a bad sign, right? So this is how you can evaluate. Just to sum up, before we move, just to sum up, what you can try and, yeah, absolutely, I'm going to share the presentation as well as the recording, right? So basically what I have just tried and given you is the idea that what you should prepare in accounting. Due to time constraint, it's not possible for me to teach you everything. But just to sum up, what you need to prepare when you sit for the placement. Number one, prepare accounting fundamentals, 3 important rules of accounting, plus what is fundamental accounting equation, what are major financial statements. Secondly, prepare what are the items in all financial statements. Balance sheet, major items, their definition, implications. Income statement, major heads, items. Cash flow statement, major heads, items. Third, how do you do the financial statement analysis? So you have to do something called a horizontal analysis and a vertical analysis and a ratio analysis. So this is what is expected from the accounting. Now, what kind of companies will test your accounting? That also I'll give you an idea. Banks will test some of the concepts of accounting. If you are sitting for financial analytics interview, actually, I'm not talking from the PPT. That's why I'm not sharing the screen. What banks are going to focus, what financial analytics firms are going to focus, they may test your accounting. Sometimes some firms are coming from accounting profile. Like some companies are coming for an accounting profile, they may test this. Then sometimes the consultancy like PwC or KPMG or these kind of firms may also come. They will test your accounting. So in case you have to work, make sure that your accounting basics are spick and span, right? You can always go back, look at the PPT of your accounting course and focus on these areas.